Today, our topic is Let's Talk Tax Planning, and we are going to hear from Alison Fleming, president here at Lumena Financial Strategies. Alison is a certified financial planner practitioner, and for those of you who may be joining us for the first time, I'll go ahead and introduce her. Alison has been a financial advisor since 1989 and serves clients in 29 states across the country. She holds a bachelor's degree in speech communication from Cal State Long Beach and believes that we must always adapt to the changing environment, remain current, and take advantage of opportunities to improve our clients' lives. Our local motto, be a long-term thinker, not a short-term worrier, serves as the cornerstone of her discussions. With that, I'll go ahead and welcome your host, Alison Fleming, who is also your presenter today.
Hi, everybody. Thank you so much for taking your time with us again this afternoon on this lovely Wednesday here. It's beautiful in San Diego. I will let you know that I'm coming to you from my home office. It feels like our COVID days are back, but not actually, thankfully. It's just our internet. So if you do happen to hear a large dog barking in the background, please forgive me. It's Max because the evil Amazon delivery man might drive by. He is nefarious and horrible. I'll just have you know that right now. Anyways, I appreciate you joining us today. I'd like to go ahead and introduce our team before we go into the content of the presentation. So, of course, you know me. We have Miles Fleming, our Executive Vice President and Insurance Specialist. I will have you know he specializes in Medicare supplement insurance, and we are coming up on open enrollment time. So if you have any questions, he's the person to talk to. We have Britt Stevens, who's our Vice President, Peter Fink, who's our resident stock picker. We have Damian Feldman, our Client Experience Manager, who is going to probably pester most of you for appointments if you haven't pestered him first. Terry Jocelyn is our Executive Assistant and Administrative Manager. We have Maddie Yola, who is on our Los Angeles San Pedro office. Many of you who are up that way probably got a postcard to let you know that we'd opened a second location up that direction. So more to come on that one. Kaylee Kaufman, Client Care Coordinator, who will soon be Kaylee Levin because she just got married. She is out for a couple weeks on her honeymoon at this moment. We have Justin Romine, who's our support specialist, working primarily with Britt. Lucy Adame, who is our administrative assistant, working primarily with Caress. And finally, the voice from the sky, the lady who runs everything, Caress Vera, our creative director, who is in charge of these webinars. So without further ado, there's our disclosure slide. I'd like to go ahead and now you're fully disclosed. So we're going to go ahead and start with Let's Talk Tax Planning. Many of you have asked, many clients have asked if we do tax planning or tax preparation. We don't do tax preparation. If we can go ahead and display the first slide there, let's talk about the difference what we are doing versus tax preparation. So it's part of our comprehensive financial planning service. Some of you have partaken in that. I do know there are some new people on the webinar as well. So just a little bit of background, we do all kinds of financial planning. We have been involved with investment management. We've done insurance planning. We do charitable gift planning. We do tax planning. We don't do tax preparation. And we've engaged with a new software that we've been using for about a year, but more as a test run. Now we're ready to launch it going into this next tax year. So it's part of our comprehensive financial planning service. If you just want to look at it in a standalone manner, that's okay too. And it's overlooked a lot of the time. Many people have asked for it. So let's talk about the four different elements. So what is tax planning, why it's important, who it's for, and what you might learn from doing it. Then I'm going to run through an example of what it looks like when someone sends us a tax return and we upload it and we start using it. I'll show you a little glimpse of what it can look like for you. So what it is, tax planning. So it's reviewing your tax return to identify potential planning opportunities now and in the future, trying to keep your lifetime tax liability as low as possible. So some people say, well, deferring taxes as long as possible is the best thing to do. And then some people say, well, I'd rather just pay it all up front now when I know I'm going to be in this particular bracket. I've heard many clients who are successfully retiring saying, hey, I thought my taxes were going to be lower in retirement. That's why I did all this pre-tax work in my 401k. But guess what? Your taxes are often not lower in retirement if we've done a good job. So we're looking at your lifetime tax liability, not just one single year. We're also looking at it in context of your beneficiaries too, if that's of interest to you, to try to figure out what's the best way to maintain family wealth over time. So it's different than tax preparation. We don't prepare your taxes. We don't fill out the forms. We don't do the calculations. We don't tell you how much you owe. This is simply designed to help us take the document, the 1040, the tax document that your CPA prepares or that you prepare yourself, and doing what if scenarios to look at different types of opportunities. So we don't tell you what you owe each year. It's an estimator. It's an illustration tool, and your actual taxes get done still by your CPA. So why is it important? Well, it basically touches every part of your financial life. It's your financial fingerprint. It's so confusing to so many people because it's really, really thick sometimes. There's a lot of things that go into the tax return and a lot of schedules and a lot of moving parts. Most people don't understand their tax return. A lot of people, believe it or not, don't even know how much money they make on an annual basis. They just know they have enough to get by month to month. Some people are well aware of what they make and what their taxes are, and they really do it with a fine-tooth comb. So this can help sort of demystify what the tax return is telling us, and can help us with a lot of things. Most recently, I worked with a client who we did this for because she's trying to figure out how much can she take out of her taxable accounts and still qualify potentially for subsidies for her health insurance. So it can be done to target items like that. Who's it for? Everybody. There isn't anybody that couldn't benefit from doing this. You don't have to owe a lot in taxes. You don't have to have a fancy situation. I think it can benefit everybody who wants to take the time to do it, basically for relevant planning opportunities. So, worst case scenario, we'll figure out you're doing everything that you can do and there's nothing more that can really be done. Best case scenario, we might be able to find some ideas on how you can save taxes now and or in the future, and opportunities where you still have room to make some changes along the way. And if we find out that you've done everything you can do, excellent. If we find out you've got some more to do, also excellent. So some things that we could identify just as a snapshot here is efficient tax efficient retirement vehicles, whether it's a IRA or contributing more to your 401k or other types of retirement vehicles. We might be able to find some of those. Realizing capital gains. That's a big one because capital gains tax rates are different than ordinary income tax rates. And depending upon where you fall on those different brackets, there could be some opportunities there. There's also charitable giving strategies, particularly for people who are in retirement. If you are over 70 and a half, and whether or not you are hitting the RMD age, there are some charitable giving opportunities that are available to you that are unique, and many people don't know about that. And finally, Roth IRA conversions. I'm having a lot of those conversations these days because people have a lot of pre-tax money that they're thinking may not be the best situation later on down the road. So those are the things that we're, just a few examples of what we might run into when we look at your tax report. So let's take a look at an example here. I'm going to go ahead and share my screen. So here is Peter Professor sample report. He is not a real guy. We can mess with his stuff and we will not mess up his life. But he's an example of what might come from a tax report that we might include in our service. So we received his tax return. In this case, it was 2023, where he uploaded his tax return. That was then scanned into the system, the numbers only and the data only, not his personal information. And so we're able to look at his tax report. Here's what it comes out to look like. All right, so there's some key figures on here. There are his total income, the adjusted gross income. We have some deductions in there to come up with his taxable income and the total federal income tax on that. All right, he's married filing jointly, and we figured out that his marginal tax bracket is 22%. His average is 10.8. So I'll talk about that in a moment, how come those two are different. And then his safe harbor is his basically penalty-proof number for what he would need to pay in order to avoid any kind of penalties on his taxes. He has some dividends that he's receiving, and he's got some capital gains. He doesn't have any carry forward losses, and he's got some tax credits. Okay, so if we go on down here, here's our first sort of bogey, right? It's showing us when he's between $0 and $22,000 of income, he's paying 10% on that. So that tax is $2,200. Then from 22 to 89,450, he's in the 12% bracket. So he's got $67,000 in that bracket. So the tax on that piece is $8,094. Then over 89,000 and under 190,000 is $53,000 of ordinary income, and he's getting 11,689 on that one. So you can see how it sort of goes up to your marginal tax rates. And over here is a little chart that shows us that he's got some room in between the 12% up to the top of the 22% bracket for his adjusted gross income. He's got about $48,000 worth of room in his bracket. So if I was thinking about, what could we do to help him in the future? And he said, maybe I want to do a Roth conversion, but I don't know how much I want to do. I'm thinking I might have too much in my retirement accounts, and I'd like to take a look at that. We know now that here is one of the numbers that we need to look at. We know 48,000 is one of his bogeys. Okay. Keep on going. Capital gains. Here's another bogey. So 0 to 89,250, there's no taxes on those capital gains if your income is below that. Between 89,250 and 553, he's getting taxed at 15% of all of his capital gains. So he has $5,475 of tax on his capital gains that he incurred this year. So there is some room to go, but really that's not that important of a number because it's a really wide bracket unless you are over 553,000 in income, and then it makes a difference. This is a part that a lot of clients don't realize is really an issue to think about if you are 65 or older and you're on Medicare. So there is a threshold up to $212,000 where your Part B premium is a flat rate. It's $185. So that means $185 a month comes out of your Social Security check and it covers your Part B premium. Now, there could be charges over and above that. Your Part D is your Medicare drug plan, whatever that is. And then you have your Medicare supplement of whatever that is. So this doesn't apply to people who have the Medicare Advantage. It applies to people who have the traditional Medicare. Between 212 and 266, they ding you an extra $74 on top of your $185 for your basic Medicare. It's an upcharge based on your income. plus you have to pay whatever your premium is, and they upcharge you $13.70 a month on top of that for your drug plan. So if you keep on going, we notice that, okay, you've got room on certain brackets, right? So here, your ordinary income, you had room up to $190,000. But if you go all the way up to $190,000, you're still in this bracket. If you go over to 12, you're going to get dinged. And this is your ordinary income. So we take a look at these, and some people say, you know what? I don't really care. I'm going to go ahead and do this anyway. And I know I'm going to get charged extra, but it's the way it goes. And other people go, you know what? No, I want to stay under that limit so that we can figure out how to make the best use of those dollars. So in this case, we have also Peter Professor has itemized deductions on his tax return. So he pays $10,000 in state and local taxes. He's got $22,000 in mortgage interest. He gave $10,000 to charity. So that gets him $42,000 in deductions. Standardized deduction or standard deduction is at 27.7. And so he exceeded that number. So he did do a Schedule A and did itemize his deductions. If he didn't have mortgage interest to pay, and if he didn't do any gifts to charity, then his state and local taxes would not be an issue because he'd be under that number anyway. Where we see real differences is if someone cannot itemize because they don't have a large dollar amount and they're giving to charity, many times their charitable gifts are being sort of lost in the mix because they're giving to charity, but they're not itemizing their deductions. So it doesn't really make a difference on their tax return. That's where those charitable gifts can come into play if you're over age 70 and a half, where we can do some kind of interesting things. In this case, also, he has some interest coming from different places, and he has some capital gains coming in. And if someone had carry forward losses, this would take into account. So any capital gains that were incurred would go against the losses. And then if there's still a carry forward loss, there's another $3,000 that you can take on top of that as a loss against your income. So I'm going to skip down here to show you there's also planning considerations that the system can pick up for us to talk about. So here are all these different things that have possible opportunities, and it's going to tell us whether you're above or below the line, or whether you're in the phase out of a particular range of numbers. So it's pretty comprehensive, gives you all kinds of different deductions and credits that can be claimed. And then it's going to give us a good number of observations to at least consider. For example, here's one. You're in the 22% marginal bracket. Depending on your age and income projections, you might consider a Roth conversion. So when we look at his actual scenarios, I'm going to show you how it does that. So with that, I think I'd like to go ahead and show you the next piece, which is his scenario analysis. So what I did is I took his scenario from 2023, which was preloaded from his tax return, and I created a tax year 2024 scenario. I didn't really change any numbers, but I applied the tax year 2024 so that all the new tax laws applied to 2024. And then I created a new scenario that said, here's 2025. How does that change everything for him? So we're assuming that he makes the same amount of money. Now, we could increase his wages if we thought he was going to get a pay raise, or we could reduce his wages if we thought he was going to take a pay cut. I just left all of his interest and his dividends the same. Although again, if we thought we were going to make more or make less, we could certainly model that in here. He had some IRA distributions as well, and but didn't take any kind of pensions, wasn't getting Social Security or anything like that. He did have his capital gains in there, and so forth and so on. So down here, it's showing us here's his total income, right? And everything here is the same because we didn't mess with any of the income numbers. Um, Itemized deductions did go up because there were extra credits and things that could be done in 2025 that were not available in 2024 to the tune of $4,400 more in deductions that were able to be taken. So, all things being equal, in 2025, his effective tax rate went down a little bit. So from 2023, it went down, and from 24 to 25, it went down just a little bit. The total tax that he is paying also went down a little bit. And then if we look at the California state numbers, that really didn't change too much, just a scooch, just a little bit, nothing much. So he paid in, the tax on it in 2024 was 24,723. His safe harbor was 22,251. So that's where he's penalty proof. He had 25,000 withheld, so he is good. He's not getting a penalty. And he had actually a difference. He got a little refund of $277. Now on the state, he owed $3,400 because he didn't have enough withholdings taken out. So that's one thing we can look at as far as, are you breaking even? Are you owing? Are you getting too much money back? So we take that forward to 2025, and we apply the same numbers. So let's just say he came in and said, well, you know what? I'm thinking about doing a Roth conversion because I really want to know, I really think I have too much pre-tax money. I'd like to pay more of the taxes now and spread it out along the way. Before I make any changes in front of you, let me remind everybody, whoever is interested in this, a few years ago, they changed the rules for beneficiaries who are not spouses. So if you're married and one of you dies, the other one can take over the IRA or the qualified retirement account as their own, and everything continues as if it's their own. If you are single or you've lost your spouse previously, and now your retirement accounts are going to someone other than a spouse, other than a charity, kids, grandkids, friends, whatever, they have only 10 years in which to take that money out. And it used to be that there was something called a stretch IRA, which meant that those people could also stretch it over their lifetime and actually pass it along to the next generation. That went away in 2018 to 20, and that grouping of tax law changes. That stretch IRA went away, and we now have the 10-year rule, where as a non-spouse beneficiary, you have to take it out within 10 years. You have to take a minimal amount each year, and it all has to get out within 10 years. So the question is, how do we do that most effectively? Some people say, I want to take the minimum out and take it all at the end because then it can grow more, but then you have your taxes to pay. Some people say, well, I want to take it now because I'm expecting to get a promotion. I'm paying less taxes now than I will later, and anywhere in between. The key is we got to figure out how is it best to be done, right? Some people also with this knowledge have decided that they want to incur some of the tax liability themselves and not put the entire burden on the next generation to pay all the taxes. So they're willing to pay a little more themselves in order to not make it so hairy for their kids. So You may be one of those people that says, too bad they're going to get all this money, they can pay the taxes, whatever, in which case that is fine too. So I'm going to go ahead and share my screen again to show you how it changes what we're talking about. All right. So assuming we're going to leave everything else the same, we're just going to do a Roth conversion. I can go in here and I can say, I think I'm going to do $25,000 of a Roth conversion. And from that, I'm going to try holding out $4,000 of federal and $1,000 of state. So it'll give me a nice round 20 grand to go ahead and show up in my Roth IRA. It changes the rate a little bit, not that much. If we add that there, let's go take a look at the bottom line. All the rest of the stuff is all the same, right? Everything else stays the same. Here's what it does. It takes your effective rate up from 13.8 to 14.6. The rest of it stays the same. The marginal tax bracket stays the same. The total tax goes up by a little bit. And if we keep on going down to the very bottom line, what we see is that the total tax goes up to 29,000. They have actually withheld 29,000. So they're going to get 180 bucks that they got to write a check for. Now here, they also only withheld $1,000. And so they still have more to pay to the state. So probably if we were really doing this case, we would look at perhaps more state withholding out of that $25,000 to try to make this go away. Maybe we would do 5,000 for the feds and 5,000 for the state. If really what you're trying to do is equalize your tax liability over time. We can look at different ways of doing it, pushing you up to the area of your tax brackets or your bogeys that you want to stay under. The advantage would be incurring the tax liability now while we know that you're only in a marginal bracket of 9.3%. We don't know what the tax rates are going to be going into the future. However, when the laws do change, the program also adapts. So here's your current tax law. Here's without the sunset, with the sunset. If things change, this gets updated immediately. So we can just rerun the scenario to see what that ends up to be. So hopefully that helps. We can do any number of scenarios. You can see how quick it is. You can see that you can participate. Caress, you want to show that slide now? This is how you would participate, is you would let us know that you want to do it, right? And so to get started, we need your most recent tax return. And that would be your 1040, federal tax return. But wait, don't just hit send on your email. You want to make sure that you protect your PII. So anything that has your personally identifiable information is very crucial that you don't just send it off in a regular old email. So any of these things are important to secure. So here's 4 ways that you can send us your tax return. If you're in the area, you can drop it off. You can mail it to us if you want, even if you're not in the area. You could request a secure email link from our team. Then you can reply to that link with the PDF copy of your tax return. LPL's account view, if some of you have that, they have a document upload feature. When you log in there, it says documents, and then you just go to my documents. You can select any of your accounts from there and just attach your tax return. You have to let us know you did that. Otherwise, we won't know it's there. Or the 4th way that you can do it is if you have the financial planning software already, and we've been working on some things, eMoney, now known as Wealth Vision, or Right Capital, they both have a secure vault that you can use to put things into. So I know there's a lot of different ways. Just pick one and we can help you to do it. A couple of years ago, we had these folks from First Meridian Care Services come and sit with me and talk about, how to obtain care for loved ones in when they need long-term care services. And so caring for parents, how to navigate a healthcare crisis, that's their topic this year. Um, some of you know that I went through this personally with my mom over the last several years, and she passed in May. These guys were very, very, very helpful in my life personally. So I wanted to share with all of you a little bit about how they helped because it really did make things easier and they really do know what they're talking about and they're very honest. So that's coming up November the 12th, 4 o'clock, same time, same station. And the registration link is open, I believe. Um, and so you'll receive the invitation for that. But this is the really fun part. We're going to do our 6th annual Toys for Tots toy drive. We're doing San Diego, and it's going to be on December the 4th. We're doing our wrap-up party, and in our new San Pedro location, Thursday, December the 11th. If you can't make it that day, well, we're having open house. Anybody can drop stuff off. In San Diego, we're open from 9 a.m. to 5 to 4 p.m., we say. We're actually open till 5, but if you come at 5, you might miss us. But by appointment in San Pedro, we would love to see you just stop by. If you can't and you want to come to the wrap-up party, that would be great. We're serving Mendocino Farm snacks and sweets there. It's going to be fun. If you can't come at all because you're not in the neighborhood or it doesn't work out for you, I would just point out to you down on the bottom of this, I don't know if I can highlight it or not, but there's a Toys for Tots link there, toysfortotsbox.com. If you look underneath the teddy bear, keep on going down. There you go. Thank you, Caress. toysfortotsbox.com. You can make your donation directly online if you still wanted to support the cause. So I would just encourage you to think about that, and hopefully we'll see a lot of you guys who are local in one of those 2 locations. And then finally, I would like to just remind you that if you have any other questions, if you have any thoughts, if you have a webinar idea for next year, we're building out our calendar. We have about half the slots filled, but I know if you've got something that you would like to hear about, we probably have access to it, and Caress would love to hear from you on that one. So thank you again. We're going to end a little early today. Have a great rest of your day, and we'll see you next time. Take care.